Hello, and welcome to Terry Beckert's GovCon podcast, where we discuss current government contracting trends, compliance matters, and best practices to guide federal contractors forward. I'm Brendan Halloran, a senior manager with Terry Bekaert, and with me today is John Ure, a partner in Terry Beckert's tax services. Today, we're doing part 2 of our podcast series on considerations during an acquisition, specifically where a government contract or contractor is involved. Thanks for joining me today, John.
Yeah, thanks, Brendan.
So I know in part 1 of the series, we talked about a lot of the items in terms of due diligence and what do companies need to consider, whether they're going to potentially be acquired or acquiring a company that does have federal contracts, and potentially maybe that's a significant part of their business. So just following on that, some of the administrative items that are really quite critical to that process. Once you've kind of gone through and understand the impact of what the acquisition would have to that government contract business. We thought it would be helpful to kind of talk through some of the additional administrative steps, as well as some of the tax considerations as well. So just to start off, one of the areas we get, a lot of inquiries and questions on, is, really what is, a novation or a contract novation, and what is the process and steps associated with that. So I just wanted to, kind of touch briefly. It's certainly a topic that, there's a lot of detail that needs to be gathered, and certainly a lot of coordination with the government, and particularly the administrative contracting officer. So we certainly won't cover that all today, but just some of the basics in terms of, what folks need to be thinking about, if that's going to apply, and, what are some of the initial steps that they really do need to understand and start planning for. So, really just to, kind of, set the tone for, what is the government's, view on contract novations. And so certainly the government, sees, the potential for risk, with any transfer of contracts. And so, with that, they really do want to get into the details of, if a company is, being bought, and then, the performance of those government contracts is then, going to, actually, transfer. And so, really FAR, addresses this in, 4212 in terms of, it's really ultimately, the recognition, of a success or an interest to government contracts when contractor assets are transferred. And so, the way the process works is that you really do need to identify, who that administrative contracting officer is, who would be, cognizant or responsible for reviewing and ultimately, executing a novation agreement. And so, I'll kind of reference, in some cases, it could be an agency such as, DCMA or Defense Contract Management Agency, and all would follow a fairly similar process. In fact, the Novation Agreement itself, the format for that is, expressly stated within FAR. So there's not a lot of latitude to, adjust how that is written. There may be some circumstances where the government would permit, some particular detail to be called out, but it really does need to follow the FAR. In terms of, what are those, initial steps, there's typically, a checklist available, and that's something that companies can work through with their ACO to determine what their expectation is for that novation package. And so that's something that the contracting officer will review. They will look to functional specialists like financial capability, as well as their legal counsel. They play a very integral part of that, and so they really want to understand kind of the before and after state. So they will get into, financials, a lot of detail on actual contracts. They actually do have to reach out to the, individual contracts or contracting officers for those to, basically notify them that, novation is being considered, and, ensure that, that those contracting offices don't have, any reservations about it. So a lot of coordination and time at the onset, and, and then, really developing what the details are. And individual contracting officers, and based on the circumstance, may ask for additional details that may seem a little bit non-standard, but they do have the latitude to, request that information to consider it. And so, really, one of the things that, in my experience working through novations, that I've always told, contractors or companies that, that it applies to, is that, really engage their legal counsel, as well as the ACO and the ACO's legal counsel right at the beginning, because that really saves a lot of back and forth and time, and will, get everyone on the same page, allow that conversation to really kind of talk through, what's needed and what can be provided, and, really sets the tone for, a coordinated effort. And just to, kind of let folks know in terms of timing, I mean, this really is typically, a months long process. So, don't do this, at the last minute and expect that it's something you can accomplish and that you'll get a novation agreement in a short period of time. You really do need to allow yourself some room to work through that. So that's, just kind of initial thoughts on, what folks need to kind of know about the process and what applies, and who some of the key, key parties to that will be. And, they certainly, depending on the number of contracts, that, is probably one of the biggest factors in just the coordination effort, notifications, and, ensuring that everything, that your data is good to go along with that actual agreement. But so moving on from, kind of that step of the process, and so that's really assuming that you made an acquisition and you're actually going to integrate, that company or organization, into yours. And so, again, folks may put that off for a period of time, but, it certainly is one that, with all of the activity in today's market, is, certainly a hot topic, and a lot of activity around it. But, one of the things, I wanted to kind of get some feedback from you, John, on is, we have just so many, government contractor clients, and many of them are S corporations. But, what are some of the standard considerations for an S corp, in acquisitions?
Yeah, that's a good question, Brendan. And as you know, we have clients across the spectrum. Many of the smaller ones, the ones generally that are acquired, are either partnerships or S corporations, and then you have your C corporations that are a little bit different animal. S corporations are historically the more complicated structures, because there's a few items typically that's gone through during due diligence, that if they're not clarified and confirmed, there can be issues down the road. So to answer your question, a couple of the standard considerations really depends if you're the buyer or the seller. So if you're a shareholder and you're selling the company, you want to receive long-term capital gains tax on instead of ordinary rates on the proceeds. We want to minimize state income taxes. Potentially, would like to defer the recognition of any rollover equity, and then also we'd potentially like to defer gain with respect to any deferred payments. We also would like to sell, as a shareholder, the stock of the company, sell the whole company instead of the assets, because when we sell the stock, we are, all liability and everything goes with the new buyer and does not rest with us as the sellers. A buyer, on the other hand, just wants the opposite. They don't want typically to purchase the stock because of that liability. They prefer to buy the assets, not just from a liability perspective, but also because they are able to receive a step up in those basis of those assets, so that they can then depreciate the purchase price over a set number of years. The buyer also wants to avoid any risk as it comes to the S election, and we'll talk a little bit about that. And then they want to, generally maintain the EIN of the target, and as you mentioned, the contracts and other things like that. They're more non-tax considerations. So with an S corporation, typically, as soon as a letter of intent (LOI) is signed, we'll go through some due diligence. And the two major issues that we'll look at, as I mentioned, is the S election. Can we confirm that it's valid? And that comes down to, was the election made? Do we have confirmation that the 2553 form was filed, and we have confirmation from IRS that it is an S election? Have we treated it, and have we filed tax returns treating it as an S election all these years? And then what type we usually look at the classes of stock. So S corporations can only have one class of stock, and sometimes when owners start to become creative with different types of equity, or maybe compensation from an equity standpoint of key employees or new owners, they can cross the line, and that becomes a second class of stock. And when that happens, the S election, it becomes invalid, and the corporation then becomes a C corporation, which is very different. It's not a pass-through entity. It files its own tax return and pays its own taxes. And so if it's discovered that now there's a second class of stock, from 4 years ago, whenever the change was made, it's a big problem, and sometimes it'll kill a deal. So those are a few things that we'll look at initially, just to make sure that we're still in S election, that we have been and we remain one. Another kind of a lot of our listeners may have heard of is when an S corp is selling. As I mentioned, the buyers want to sell stock, and the sellers want to sell stock, and the buyers want to purchase assets. There's an election that's called a 338H10 election that IRS allows the treatment of a stock sale to be treated by the buyers as an asset sale. So they still get that step up in the assets. That's a very popular option. There's another scenario called an F reorganization, where it's a little more flexible even than a 338H10, but essentially the buyer and the sellers can all be satisfied for the most part on some of the more critical and important demands that they have. And so we'll go through these different types of structures, and generally those are pretty good options for both parties.
Yeah, no, it's interesting, and this is just kind of a more kind of government focus. Thought on that is that certainly when you talked about kind of the stock versus asset, is that with the kind of before and after financial reporting and review that would go as part of the novation process that we talked about earlier, certainly the government really wants to confirm that if that contract is going to be novated, that again, and this is kind of using the term broadly, but that the assets are in place to continue successful performance of those contracts for the duration. And so they as you're as folks are really kind of talking through and kind of determining how that deal structure is going to be, those are certainly high visibility areas, at least from the government perspective.
Yep. Agreed.
So there's certainly lots of ways for owners to be bought out of their company. What are a few of the kind of the more popular or frequently used ways that we see that?
Yeah, no, good question. So from a tax perspective, obviously you can just do the one and done type payment, where in a single year you sell all of your ownership in the company, and then all of it is taxed during that year. The benefits from that is you get your money up front, but the downside from a tax perspective is it generally puts you into the highest tax bracket, and you're paying at the highest rates. Now, a lot of our owners are already at the highest rates, so that maybe that's not a big difference for you, but it could depend. Some other sale structures that we at least explore are an installment sale where the purchase price is treated as expanding over 2 or more years. So you would receive and recognize X percentage of the sale price this year, and X percent next year, and so on. And what that does is spread out your tax liability over several different years. Some of our owners, they're retiring after they sell the company, and they're no longer going to be bringing in a paycheck or significant income. And so if we can stretch out these payments over several years, sometimes that reduces their tax liability, or sometimes it just allows them to have that security of having those payments come in for that time frame. It really depends on the size of the company, the size of the sale, whether or not that is a feasible option from a tax stand, not feasible, but a recommended strategy from a tax standpoint. Another option is, and I mentioned earlier, is a deferred payment or rollover equity, which typically will take place in a little more complex structures where the seller will sell either part of the company to the buyer or all of it to the buyer, but then receive back part equity or ownership in the new entity that's formed. The benefit to that, and from a tax perspective, is you are able to recognize in the current year the sales price of whatever you sold that year. But the rollover equity piece is it's a little bit of a tax strategy. It's more of a financial strategy. The clients that I've worked with this on, it's like a second bite at the apple, because typically when a new buyer comes in, they have more resources, they're a bigger company, and they can make the company that was purchased the target. They can grow that and make it more profitable in future years. So if you have a rollover equity piece that will be bought out from you in 5 years that you hold on to, typically that equity piece is very valuable, sometimes even more valuable than the original purchase price. And from a tax standpoint, that's, we can go through a few options of how to handle that tax liability, but it's also a very popular option, especially if the owner is going to stay on. Sometimes they stay on as some kind of consultant role or leadership role. And so again, that's another a piece to motivate them and to incentivize them to help the company continue to grow. And as they see that grow, they know that they're going to get a piece of that eventually.
Yeah, that's really interesting. So in terms of, on the the rollover, obviously there's, if the seller really sees, potential, over future years, I mean, certainly would be beneficial to them. Is that something that, that the buyers are usually, willing to consider, or is it really driven by, like, how much can the owner bring, in terms of, program relationships, or, kind of that consulting, that you mentioned. Are there any things that you've seen that kind of, shake out of that in terms of being real, the real kind of driving points that make that an option that they both agree on?
Yeah, so it obviously depends on the scenario, but typically the situations in which we see this is where you have, typically the founders, they've been there from the beginning. The owners, they've run it successfully, or they wouldn't be at this point typically. And a lot of times they're a significant piece of the company, whether they help the company morale. People trust them, their employees trust them, they know, or they have contacts in the industry, or they have just somewhat irreplaceable relationships with the clients, maybe at this point. And so that they want that figurehead to stay on board, roll over with them to transition the ownership of the company. A lot of times owners, a lot of owners treat their companies like their children, right? They've watched them grow up, they've sacrificed, they've done so much with them. So they want to stay on. They want to make sure that the transition goes over smoothly. And so generally, if it's a concern of the owner and they want to stay on longer, then that generally can be arranged from what I've seen. And then in certain circumstances, it certainly has been one of the qualifications, one of the requirements that the seller puts in place to ask the buyer that, it's part of the contract that they do have to stay on for X number of years, because it's that important to the seller.
Yeah, gotcha.
I'm
Yeah, no,
sorry, the buyer.
they've got, so much vested in building that. I can certainly see why many would want to stay on a little bit longer.
Right.
So, C corporations, are certainly taxed, differently than pass-through entities like, partnerships and S corps. What are some of the sales structures that you've seen are, popular for C corps?
Yeah, that's a good question. So some of the same structures are available for C corporations. As you mentioned, it's a very different animal. There's still some strategies. One that I see overlooked somewhat frequently, is it's called a 1202 sale. It comes from Code Section 1202, and it's only in place for C corporations, and it's meant to be an incentive for small businesses as they grow and then sell. But essentially, there are some restrictions there. I won't get into at this point, but it will allow eligible stockholders to claim a minimum of $10 million of federal income tax gain exclusion on the sale of their stock. It's called qualified small business stock that's held for more than 5 years. Now, the owners it has to be originally issued by the corporation, meaning they can't have purchased it from someone else. They have to have held it for 5 years, as I mentioned, and there's some size requirements, but even larger businesses can take advantage of this from what I've seen. And it's really, I said a minimum of 10 million. That's kind of the baseline. It can even go up higher than that depending on the situation. It's the greater, the exclusion is the greater of 10 million or 10 times the owner's initial basis. So, for example, if I have an owner who has a $2 million basis in the company and he holds it for 5 years and so forth, meets all the qualifications, and say he sells it for $22 million as an example. His basis is 2 million. His gain is his sales price is 22, so the gain is 20, and that entire amount, the 20 million, since it's 10 times his original basis, would be excluded from federal federal income tax. Sorry. And that's a great option, especially because some states, they also adopt the 1202, so it's not taxed for federal purposes. It may not be taxed for state purposes either, so you get out of another tax regime that way. And I think I did the numbers on this. You save, depending on the state, obviously, but you can save around $6 million on a $22 million transaction when if 1202 applies. So I've seen this messed up a few times though, where the owners are doing something prior to the sale, and whether that's estate planning or some other kind of creative ownership plan, and they negate 1202. They kick themselves out of the 1202 eligibility, and that is just obviously a heartbreaking scenario. People are sued, things go badly. So
Yeah, I can
just
imagine.
something you want to keep track of, because obviously that's a huge difference if you're able to take advantage of that.
Yeah, no, I mean, that's really, potentially significant. So, that's a great option to bring up and talk through. So, certainly as we, work through, or work with, clients of all sizes, and some of them, we've kind of seen, grow from that startup to, kind of, really medium to, even large business in some cases. And certainly if they're looking to, potentially, sell, with all of the things, we've talked a little bit about, some of the, kind of regulatory and compliance, issues that certainly are pretty significant. Obviously, there's a lot of, kind of the leading up to, what could potentially be a deal. But, is there anything, for those, actual owners, that they should also kind of add to their list of things to do, just from, a tax and planning standpoint, before they get to the, get to that stage where, they're, potentially looking at a LOI?
Yeah, good question. And I'll wrap up with this. But I think one of the most beneficial things an owner can do is to look at their estate plan. A lot of owners are just, as you mentioned, they're so busy with everything, running their company, looking at offers, doing different things that it doesn't really occur to them, which it probably wouldn't because they're not, necessarily thinking along those lines. But in the scenarios where we're able to do a little estate planning beforehand, we can take some of the stock in this company or the ownership, put it into a trust, for example, or even gift it to a third party. But typically, we're putting into a trust. If we do that before the LOI is signed, we can take a much bigger discount on the value of that company. And then when the transaction occurs, we have successfully taken that portion of the ownership. We've been able to utilize to the really the best extent possible the owner's estate tax exemption, put it into a trust. All that future appreciation grows outside of his or her estate, and we don't have to worry about using exemption in the future on gifting and getting these assets out of the estate. So it's a very powerful way to plan, especially if you're expecting a significant amount of money. Now, the federal estate tax exemption currently is $12 million. That went up to $10 million in 2018 and has been adjusted for inflation. At the end of 2025, at the beginning of 2026, that exemption is going to drop back down to 5 million, adjusted for inflation. So it's like 5.5 million. And IRS has confirmed that if we are able to gift out up to $12 million of our estate, when that drops back down to 5.5 in 2026, there won't be a clawback. They're not going to come back and say, okay, well, you gifted more than the 5.5, so now we're going to assess gift tax or estate tax on this. That won't happen. So what's happening now is a lot of people are gifting up to the 12 million if they have those kinds of assets. For government contractors, a lot of these sales are in the tens of millions of dollars. We'll walk through typically with your financial planner, with your attorney. We'll kind of do a roundtable discussion, and if it makes sense, we can take some of this interest, put it in a trust for children or whoever you want to be the beneficiaries, and get that out of your estate. And that's a really powerful way to avoid the 40% federal estate tax when you pass away. And a lot of states, like we're in Maryland, DC area, that's another 16% on top of that from a state perspective. So you're saving over 50% on these items, and that's future appreciation that's included as well. So it can be very powerful.
Yeah, those are really kind of huge figures. So really important to take advantage of as many of those options. If you're in the position to actually sell, to really take the time and get the expertise to do that planning.
Yeah. And Brendan, if I can ask you just a quick final question, not tax related, but so I have clients where they have purchased a company, and what are some scenarios that contractors can use when you're bringing on an acquisition that may be specific to government contractors, or at least can help them if they're bringing on a new purchase?
Yeah, no, that's excellent question, and certainly a lot of time gets put into figuring out what works best, and depending on the size of the organizations involved, there's a couple of kind of main approaches. You can dissolve the entity, and begin to integrate it into the organization. And so from a government contract perspective, that certainly covers, some of the areas in terms of the, contract novation. And so you would need to be pretty far, along the path of, planning there. So actually getting the contracts novated, determining, how the business systems in terms of, what kind of accounting system and practices are in place, how you're actually going to, bring those and integrate them. Another option is, and I've seen this, done quite a bit, where you've got, a larger company or contractor that makes an acquisition, is to, really run it, as a wholly owned subsidiary for a period of time. And in a lot of instances, I see that, for, 2 or 3 years. And it just, it avoids some of those, kind of heavy lifts in terms of, administrative and regulatory considerations in terms of, you can really put off, the novation. You can, let that subsidiary, operate under its, existing, accounting practices and any other systems it has in place to support those contracts, and really allow for, the proper planning to, integrate them, at a point down the road. And that's when, you can, really plan for, here's a point where, we anticipate dissolving this entity and really kind of folding it into the, into the new organization. And so, each one, I think, brings, a lot of, benefits and challenges. And, a big part of that is really, how well prepared, and how well do you understand some of the things that you'd have to navigate, through, kind of the oversight and, contract requirements. So certainly, lots of, kind of combinations of ways that folks can do that. But, those are a couple of the main ones that I've seen. And so, certainly anyone looking at acquisition or, being acquired, there's a lot of, kind of groundwork you can do to, be better prepared to determine what the right path is for that.
Yeah. Excellent. Thanks.
Yeah, sure thing. Great. So I know we've covered a lot of territory, and but probably have only, scratched the surface of all the, considerations, when companies are at this stage, and particularly, if it involves, federal government contractors. But certainly appreciate your time, John. Great insight, and I think a lot of good ideas that hopefully prompt questions, and and certainly provide at least a little bit of a start on guidance for listeners. So, but anyway, thanks everyone for joining us. If you have any questions, feel free to email John at john.ure@cbh.com, or myself at brendan.halloran@cbh.com. And please join us again for our next podcast.